The IRS quietly changes the rules the moment you turn 70 and a half. Not at 73 when RMDs begin, not at 72, not at 71. At exactly 70 and a half, 7 specific provisions unlock that can legally eliminate thousands of dollars in federal taxes every single year for the rest of your life. And the overwhelming majority of American retirees will never use a single one of them, not because they are complicated, not because they require a lawyer or a financial advisor, but simply because nobody explains that the rules change at this exact age. Most people believe the important retirement ages are 59 and a half when the early withdrawal penalty disappears, 62 when Social Security becomes available, 65 when Medicare starts, and 73 or 75 when required minimum distributions begin. Those ages get all the attention. Age 70 and a half gets ignored, and that silence costs retirees real money every single year. They remain unaware of it. What follows covers all 7 provisions in plain language with real numbers, so you understand exactly what is available to you right now and exactly how to use it. Before going further, nothing here is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. The first and most powerful provision that unlocks at 70 and a half is the qualified charitable distribution, commonly called the QCD. This is the single most effective tax tool available to any retiree who gives money to charity, and most people either do not know it exists or do not understand how valuable it actually is. Starting at exactly age 70 and a half, you can transfer money directly from your traditional IRA to any qualified 501c3 charity. The maximum QCD amount for 2026 is $111,000 per person. If you are married and both spouses are over 70 and a half, each of you can do $111,000 from your own IRA for a combined total of $222,000. Here is what makes the QCD so extraordinarily powerful. The money goes directly from your IRA custodian to the charity. It never touches your bank account. It never appears on your tax return as income. It does not increase your adjusted gross income. It does not increase your provisional income. It does not push your Social Security benefits into the taxable zone. It does not trigger IRMAA Medicare surcharges. It is completely invisible to every tax calculation the IRS runs on your return. And once you reach the age when RMDs begin, the QCD counts towards satisfying your required minimum distribution for the year. Consider what this means in practice. Without a QCD, you take a $15,000 RMD from your IRA. It appears as taxable income. It pushes your provisional income higher. Up to 85% of your Social Security becomes taxable. At a 12% bracket, the direct tax on the RMD itself is approximately $1,800. The additional tax triggered by the Social Security cascade adds another $500 to $1,000. Total tax cost of donating $15,000 to charity the conventional way, approximately $2,300 to $2,800. With a QCD, the same $15,000 goes directly from your IRA to the same charity. The RMD is satisfied. Your taxable income does not increase. Your Social Security stays out of the taxable zone. The total tax cost, $0. You save $2,300 to $2,800 by changing the route the money takes from your IRA to the charity. Same donation, same charity, same dollar amount, different route, thousands saved. If you give to charity in any amount, from $500 to your church to $50,000 to a university, and you are over 70 and a half and you are not routing those gifts through a QCD, you are handing the IRS money you do not need to hand them. Setting up a QCD with your IRA custodian, whether that is Fidelity, Schwab, Vanguard, or any other major firm, takes approximately 15 minutes. You fill out a form, name the charity, and they send the check directly. There are 3 mistakes people commonly make with QCDs that disqualify the distribution. First, Having the custodian send the money to you and then writing a personal check to the charity does not qualify. The money must go directly from the custodian to the charity without passing through your hands. Second, attempting to use a QCD with a donor-advised fund does not qualify. The money must go to an operating 501(c)(3) charity. Third, making the distribution even 1 day before turning 70 and a half does not qualify. The IRS is strict on this point. You must be exactly 70 and a half on the day the distribution is made. The second provision is newer and less well known. The Secure 2.0 Act created a one-time QCD of up to $55,000 from your IRA to fund either a charitable remainder unit trust, a charitable remainder annuity trust, or a charitable gift annuity. This is a lifetime limit, meaning you can only do it once. A charitable gift annuity or charitable remainder trust pays you income for the rest of your life and then transfers the remaining assets to the charity when you pass away. Normally, funding one of these vehicles with IRA money would require you to withdraw the funds first, pay income tax on the full withdrawal, and then contribute the after-tax amount. With this provision, you fund it directly from the IRA through a QCD. No income tax on the transfer. The charity gets funded. You receive a guaranteed lifetime income stream. The IRS receives nothing on the initial transfer. On a $55,000 transfer at a 22% tax rate, the tax savings on the transfer alone is $1,200. Add the avoided Social Security cascade and IRMAA exposure that a traditional withdrawal would have triggered, and the total tax benefit on this single transaction can exceed $15,000. This is not for every retiree. It requires working with a charity that offers gift annuities and fully understanding the payout rates and terms. But for retirees who are already charitably inclined and hold large traditional IRAs, it is one of the most tax-efficient strategies available. The third provision is the pre-RMD IRA reduction window, and this is the one that most retirees miss entirely because they do not understand the timing. QCDs become available at 70 and a half. RMDs do not begin until age 73 if you were born before 1960, or age 75 if you were born in 1960 or later. That gap between 70 and a half and the start of RMDs is a window of 2.5 to 4.5 years, during which you can use QCDs to reduce your IRA balance before the IRS begins forcing money out. Why does the balance matter? Because RMDs are calculated based on your IRA balance as of December 31st of the prior year. The higher that balance when RMDs begin, the higher the forced annual withdrawal. The higher the forced withdrawal, the more Social Security gets pushed into the taxable zone, the more likely you are to trigger IRMAA surcharges, and the higher your effective tax rate becomes for the rest of your life. If you use QCDs during the pre-RMD window to reduce your IRA balance by $50,000 to $100,000, your future RMDs shrink proportionally every single year going forward. On a reduction of $100,000, your first RMD drops by approximately $4,000 per year. That $4,000 reduction in forced income keeps your provisional income lower, keeps more of your Social Security in the non-taxable zone, and potentially keeps you below the IRMAA threshold. The pre-RMD window is finite. Once RMDs begin, the first dollars out of your IRA each year must satisfy the RMD before any additional amounts can count as a QCD. The strategic advantage of shrinking the balance before that clock starts is significant, and most people do not know the window exists until after it has already closed. The fourth provision is the last clean Roth conversion window before RMDs complicate everything. If you are 70 and a half, you have between 2.5 and 4.5 years remaining before RMDs begin, depending on your birth year. Once RMDs start, Roth conversions do not become impossible, but they become significantly harder to execute at favorable tax rates. The reason is that your RMD must be taken first before any conversion. That RMD fills the lower tax brackets. The conversion then stacks on top, often pushing into the 22% bracket or higher. At 70.5, if your income is well managed, you may still have meaningful room in the 12% bracket to convert $30,000 to $50,000 per year. At 73 or 75, when the RMD fills $15,000 to $25,000 of that bracket space first, your conversion room at 12% shrinks dramatically. Every dollar you convert at 12% now saves you 10 to 18 percentage points on that dollar later, when it would otherwise have come out as a taxable RMD at a 22 to 30% effective rate, including the Social Security cascade. On a $50,000 annual conversion, that difference represents $5,000 to $9,000 in lifetime tax savings per year of conversion. If you are 70.5 and have not started Roth conversions, you are in the last window where the mathematics works most strongly in your favor. After RMDs begin, the window does not close completely, but the benefit shrinks every year as the RMD grows larger and consumes more of the low-rate bracket space. There is also the IRMAA consideration with Roth conversions. Every dollar of Roth conversion counts toward your modified adjusted gross income. At 70.5, if your MAGI is below $106,000 as a single filer, you can convert up to that threshold without triggering Medicare surcharges. But remember the 2-year look-back rule. A conversion you do in 2026 affects your Medicare premiums in 2028. Plan your conversion amount with one eye on the tax bracket and the other eye on the IRMAA tier. The fifth provision is a reporting change that solves a problem retirees have been dealing with for years. Starting with the 2025 tax year, the IRS introduced Code Y for Box 7 of Form 1099-R. This code specifically identifies a distribution as a qualified charitable distribution. Before Code Y existed, QCDs were reported on the 1099-R exactly like regular taxable distributions. Tax software treated them as income. Taxpayers had to manually exclude them on their return, and if the software or the preparer did not handle it correctly, the retiree paid tax on money that should have been completely tax-free. This happened constantly, and many people never caught the error. Code Y eliminates that problem entirely. When your IRA custodian reports the QCD with Code Y in Box 7, your tax software automatically recognizes it as a non-taxable QCD and excludes it from income with no manual adjustment required. If you completed a QCD in 2025 or in any prior year, and your preparer included it as taxable income on your return, you may have overpaid. You can file an amended return within 3 years of the original filing date to correct the error and recover the overpaid tax. Check your 1099-R from 2025. If a QCD appears without Code Y and it was included in your taxable income, that is money the IRS owes you back. The sixth provision involves Social Security provisional income management, and at 70.5, this becomes the most important ongoing calculation in your financial life. If you delayed Social Security until age 70, your benefit is now at its permanent maximum. For every year you delayed past your full retirement age, your benefit grew by approximately 8% per year. At age 70, your monthly benefit is 132% of your full retirement age amount, locked in permanently with annual cost of living adjustments applied on top. Now the question shifts entirely from when to claim to how to protect what you are collecting from being pushed into the taxable zone. Provisional income is the calculation that determines how much of your Social Security is subject to federal income tax. Your provisional income equals your adjusted gross income plus any tax-exempt interest plus half of your annual Social Security benefit. For a single filer, if provisional income exceeds $25,000, up to 50% of Social Security becomes taxable. If it exceeds $34,000, up to 85% becomes taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. At 70.5, with a maximum Social Security benefit of approximately $40,000 per year, half of that amount, $20,000, goes directly into your provisional income calculation before you have withdrawn a single dollar from any other account. As a single filer, you have only $14,000 of space remaining before crossing the $34,000 threshold into the 85% zone. A $10,000 traditional IRA withdrawal pushes you directly across that line. A $10,000 QCD instead keeps you well below the threshold and leaves your Social Security completely out of the taxable zone. At a 12% rate, keeping $20,000 of Social Security non-taxable saves approximately $2,400 per year from one decision about how to move $10,000. The QCD provision becomes available at exactly the age when provisional income management becomes most critical, and the two provisions work together in a way the IRS does not explain and most tax software does not surface. The seventh provision involves stacking the senior bonus deduction with QCDs and Roth withdrawals to reach a legally zero federal tax bill on a meaningful retirement income. The legislation signed in 2025 created a $6,000 deduction for taxpayers aged 65 and older, and $12,000 for a married couple where both spouses are 65 or older. The income phase-out begins at $75,000 for single filers and $150,000 for married filing jointly. This deduction is temporary. It runs from 2025 through 2028 only. After 2028, unless Congress extends it, the deduction disappears. That gives you 3 remaining tax years to use it: 2026, 2027, and 2028. For a married couple, that is $36,000 in deductions over 3 years, saving approximately $4,220 at the 12% rate. Every year unused is permanent loss. The real power of this deduction is not the deduction in isolation. It is the deduction stacked with QCDs and Roth withdrawals together. Consider a retiree who needs $50,000 to cover living expenses for the year. Social Security provides $30,000. The remaining $20,000 is split as follows. $10,000 comes from a Roth IRA, which is completely tax-free and invisible to the IRS. The other $10,000 goes directly from a traditional IRA to a charity as a QCD, also completely invisible to the IRS. Adjusted gross income consists only of Social Security. Provisional income is $15,000, well below the $25,000 threshold. 0% of Social Security is taxable. The senior bonus deduction further reduces taxable income. The federal tax bill on $50,000 of real income, essentially zero. Now compare that to the retiree who pulls the full $20,000 from a traditional IRA instead of splitting it between Roth and QCD. Provisional income jumps to $35,000, crossing the $34,000 threshold. Up to 85% of Social Security becomes taxable. Federal tax lands at approximately $2,000 to $3,000. Same income, same lifestyle, same spending. One retiree pays $0, the other pays $3,000. The only difference is knowing about 3 provisions and stacking them deliberately. For retirees living in one of the states that still taxes Social Security in 2026, including Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, the stacking strategy produces savings at the state level as well. Every dollar of Social Security that stays out of the federal taxable zone is a dollar the state cannot tax either. In states like Minnesota, where the exemption phases out at higher income levels, keeping provisional income low through QCDs and Roth withdrawals can mean the difference between receiving a full state exemption and receiving none at all. Bringing all 7 provisions together, at age 70.5, the IRS unlocks the QCD, allowing up to $111,000 per year transferred directly from your IRA to charity with zero tax impact. It unlocks the one-time QCD to a charitable remainder trust or gift annuity for up to $55,000 with lifetime income flowing back to you. It opens the pre-RMD window where strategic QCDs can permanently reduce your IRA balance and shrink every future forced withdrawal. It gives you the last window where Roth conversions can be executed cleanly at the 12% rate before RMDs compress your bracket space. It introduces Code Y on the 1099-R, so QCDs are reported correctly and taxed at zero without manual intervention. It makes provisional income management the critical annual calculation for protecting your maximum Social Security benefit from unnecessary taxation. And it allows you to stack the senior bonus deduction with QCDs and Roth withdrawals to reach a legally zero effective federal tax rate on a comfortable retirement income. 7 provisions, all available right now if you are 70 and a half or older. The IRS will not explain any of them to you. Your tax software will not suggest the stack. Most preparers will not model it unless you ask directly. The retirees who use these provisions and the retirees who do not live in the same tax system file the same forms and collect the same Social Security benefits. The only difference is the information they acted on. If you have a question about how any of these provisions applies to your specific situation, drop it in the comments. Every comment is read and responses are provided. Share this with any retiree in your life who is 70 and a half or approaching it, because this information is time sensitive in a very real sense. The pre-RMD window closes when RMDs begin. The Roth conversion window narrows every year. The senior bonus deduction expires after 2028. The value of acting on what you now know is greatest the sooner you act on it. USA Retirement Guide.